Hi, everyone. It's Brad Thomas, and welcome back to the Wide Moat Show. I'm joined today with my co-host, Nick Ward. Nick, it's great to see you today.
Yeah, thanks for having me today, Brad. Thanks, for the viewers for being here. And we coordinated today, kind of subconsciously, Brad. We're both wearing green. It's a rare day. The markets are up big time this morning.
No, it's all about the green, and that's really the theme of this today. Is we want to talk about money, and not our money, but your money, and how everybody can make money in this stock market. Now, look, it's very difficult right now. It's a lot of volatility. Trump is out tweeting. Jerome Powell, the tariffs, inflation.
What do you call it? He called him the loser? What did he say yesterday? Can you remember?
Yeah, he said he's a major loser, and he said it's time to make preemptive cuts to interest rates. And of course, we do know rates is certainly going to stimulate activity in the market. But the question, Nick, is really, are we heading into a recession? We've talked about a recession on previous shows. Are we headed into a stagflation environment? And I think that's really the question. It seems to be like a coin toss as to which one we're going to actually be talking about in the next 30 to 60 to 90 days.
Yeah, well, neither of them are good, right? So that's not what investors want to hear. We've talked about this a lot. I mean, I'm really waiting for some of these pro-growth policies to come out of the White House. Not seeing them. The markets are up today because Treasury Secretary Scott Bessent said about an hour ago that the fight between the U.S. and China, the trade war, is not sustainable. That's what he said. I don't know if that means it's not sustainable for the U.S. and Trump's going to have to relent, or maybe, we're so strong, China is. I don't know. The market rallied on that comment. It'll be interesting to see, if it's a sustainable rally or not. I'm not sure, but who knows? The market's, like you said, is trading on true social posts right now and not fundamentals, and that's a problem for investors.
Yeah, well, look, I think we're seeing some potential recession risk. Last week, Volvo announced it was closing or laying off about 800 workers at 3 of the U.S. plants. So that's not good news. That's certainly indicative of a potential recession. But at the same time, there's a number of companies really close to where I am right now, close to home in South Carolina, where you're seeing a number of new announcements, companies coming in here and creating more jobs. So I think at the end of the day, it comes down to the JOB. And are we losing jobs? Or are we gaining jobs? And I think that's something that we're going to really be seeing over the next, couple of weeks. And it's good that we've got this show now, Nick, because we can every week go in and kind of tell everybody what we're seeing in the markets, which I know is really helpful to our audience.
Yeah, and earnings season's starting kind of this week. This morning, the market's up, but if you own defense stocks, defense contractors, you are not happy right now. We're seeing big losses on companies like Northrop Grumman, RTX. And why is that? It's because of tariffs. Both companies have, talked about tariffs being a big hit for them. I think, GE Aerospace and RTX, saw this headline on CNBC this morning. Combined, they're talking about over $1 billion in tariff headwinds. So that's a problem. I don't know. That may not happen, though. That's the thing, right? If that doesn't happen, these companies are going to be massive bargains. So much depends on these kind of trade agreements coming out of the White House. And, I'd love to just see them start to roll in. I think we've talked to Japan and Korea, just like, please, just if they send out an agreement, I swear the S&P, we'll see another 2% rally.
Yeah. Well, Nick, listen, I feel like Wide Moat Research is the perfect platform. And obviously I'm biased about this, but, I've spent 15 years as a Wall Street writer covering many different markets and global pandemic, obviously, recessions. And what got me to Seeking Alpha originally when I started writing was a great recession. But of all these markets that I've seen right now, I think our firm, Wide Moat Research, is best positioned to help navigate our readers and our customers to this, what we call this sleep well at night or SWAN environment. And of course, that's the topic of the day, is SWAN investing. We've had many of our readers want to talk about our SWAN stocks. So we decided today to kind of focus on SWANs. And, I think this is going to be a really, really good show.
Yeah. We're not about speculation. I think the AI trade, the luster's off of that. I haven't even heard the phrase quantum computing on the TV in a few weeks, I think. So, I think we're past that now. We're focused on True Social. I think people want to be focused on the fundamentals. That's what we're going to do today. And to talk about, what a SWAN stock is, where that idea came from, how investors can implement this kind of strategy. And then we'll show some numbers that show that, the types of stocks that Brad and I love to invest in do statistically outperform the market over long periods of time.
Absolutely. And so, again, going back to the SWAN concept, I know there's these acronyms we use, and SWAN being one of those. Of course, I had somebody just recently ask me about why do we call our company Wide Moat? And of course, I explained to them about the moat and the fortress and the competitive advantages that surround the company. And so I wanted to dig deeper today into this concept of SWAN investing. Many of you who have followed me for a long time, going all the way back probably 15 years on Seeking Alpha, I first started using this word. Now, I didn't coin the phrase. I actually mentioned this in my REIT for Dummies book, and I'll give you the actual definition. I put in the vocabulary glossary in the back of the book. The definition of a SWAN is this: a SWAN is a term used, but not coined by me, to refer to a high quality stock that is very likely to operate stress-free and offer unbroken, ever-growing dividends. So again, that is the key to being a SWAN stock. Again, we think that dividend growth and the earnings predictability and dividend predictability are really the key drivers. Now those drivers really are important to recognize, because as we evaluate companies, we look at really three critical ingredients, and let's call it the SWAN recipe. Again, first is, and this is really the most important part of our SWAN recipe, is earnings growth of the company. The company has to generate predictable earnings growth over time. I mean, when you look at these competitive advantages, you look at the cost advantage of the company or the scalability of the company, that's always reflected into the potential earnings histories of these companies. So that's extremely an important driver for us. Secondly, and this is extremely valuable for us too, is valuation. That's buying the earnings stream of the company or the cash flow of the company. If you pay too much on valuation, you'll earn less than the company's growth. A low valuation will cause you to earn more than the company's growth warrants. So when you get valuation right, and this is the key, you've got to get valuation right. You don't want to overpay. You're going to have the best long-term results. So I think that's the most important part of this of the SWAN recipe. And the last, and again, this is probably, at least from my view, one of the most important here, is the dividends. That's crucial to the blueprint, because dividends are kind of like a barometer. You can see how the company is going to perform if you look at the dividend history. Obviously, we look at the payout ratio of the company to make sure that the company is not paying out more dividends than it earned. And of course, last week we talked about sucker yields. So those are really the three biggest parts or ingredients for the SWAN recipe.
Yeah, Brad, it's funny, we're kind of talking about a lot of cooking terms here and, the SWAN recipe. And to me, what SWAN, sleeping well at night, kind of boils down to, there's my pun of the day, is literally making money while I sleep. Warren Buffett has said, if you can't figure out how to make money while you sleep, you're going to work until you die. That's not what I want to do. I would love to retire comfortably, preferably early. I'll spend a lot of time with my kids, with my wife, pursue my passion. So how do I do that? I make money while I sleep. How do I do that? I own very high quality dividend paying companies. Like you said, the wonderful thing about this strategy is you shouldn't overpay for stocks. We always say never do that. Look for margins of safety, but you don't have to get it perfect to do really well with high quality dividend paying stocks. So we love a value. Brad and I are both value investors. We look for bargains, but if you just pay fair value, if you figure out what that is, you will benefit from the earnings growth of a given company. So if a company is growing at 10% a year and you don't overpay, you just pay fair value, you should theoretically over the long term generate 10% annualized returns. If you get it at a discount, then all of a sudden that margin of safety can really boost those results, and that's great. But you don't have to. And I have some numbers here. Every year, Hartford Funds, they produce this study called The Power of Dividends, and it's my favorite thing. I look forward to it. They update the numbers, and it always just tells a story that Brad and I want to tell, in a few charts that are just, I come back to them all the time. So here's some data for you guys from this Power of Dividends study. And looking back from 1960 to 2024, so the study ended December of last year, $10,000 invested into the S&P 500 would have turned into $982,000 roughly. So that's really good. You're at 64 years, my math is correct. That's what compounding does. It turns a little bit of money into a whole lot of money. But if you add in dividends and reinvesting those dividends into this very same equation, that $10,000 turns into $6.4 million. So you go from $982,000 to $6.4 million, a large increase. And the only thing that you did differently was reinvest those dividends. You really focused on the compounding and took advantage of that process. To kind of put it more highlight on this, the company also studies from 1973 to 2024, shows what $100 would have done in a bunch of different types of stocks. So $100 into an equal weighted S&P 500 index would have turned into $4,620 roughly. Forgive me for looking down, but I do want to get these numbers right for you guys. We'll put these charts on the screen for you to look at as I talk. That same $100, if you had invested in dividend growers and dividend initiators, so companies that were doing so well, they decided to return capital to their shareholders, and then the companies that grow that shareholder returns every year, that goes up from $4,600 to nearly $16,000. So basically, we're talking not quite 4x, but a large increase. Dividend payers are basically double that equal weighted index at basically $9,700. And then down here at the bottom, you do see the dividend cutters and the dividend eliminators. So these are the companies that are not creating reliable earnings growth, that are not able to return that to shareholders in a very sustainable and reliable and a dependable way. That's down to $63. So literally over this very long period of time, you lost money, which is extremely hard to do. Every asset class over the last 50 years is up, whether we're talking gold, stocks, bonds, et cetera, real estate, you name it. It's up, except for the dividend cutters, right? So avoid those at all costs. Brad and I just talked about what a sucker yield is and how to identify those. That is so much of what we focus on at Wide Moat. We love dividends. We hate dividend cutters. We need sustainably growing dividends, which I think is probably the thing that income investors get wrong the most. I see so many people focus on yields, and the higher the yield, the better in their opinion, but that's not kind of what we focus on. In our view, the safer the dividend, the better. The more rapid the growth, the better. As Brad says, oftentimes the safest dividend is the one that has just been increased. A management team would not raise the dividend if they didn't believe in the near-term prospects of that business. And as you can see, looking at these charts down here, if you own the dividend growers over the long term, you not only just create that passive income stream that pays you while you sleep and grows while you sleep, but your capital returns are also wonderful as well. So that's kind of the end of my chart analysis here. I hope you guys enjoyed those. But like I said, the numbers speak very clearly to the point that the dividend growing companies that Brad and I talk about, these SWAN stocks, they work and they work very well.
Well, Nick, I want to throw another pun your way. The proof is in the pudding, right? So
we're knocking the ball out of the park this week.
Yeah, we're talking about SWAN recipe, folks. So I gotta keep them going. Nick, you got to keep them going too. But no, the proof is in the pudding here, because I like to refer to research. Not only, Nick, this was great research, by the way, but I like to look at academic research as well. There's a white paper that I heard about a few years ago, written by this Harvard professor by the name of Michael Jensen. And Professor Jensen wrote this white paper called Agency Cost of Free Cash Flow, Corporate Finance, and Takeovers. Now dividend policy is actually an academic topic, and I'm going to try to dummy it down a little bit for you here today. In that paper, Professor Jensen describes the free cash flow hypothesis, in which a company with too much free cash flow can result in internal insufficiency and a waste of corporate resources, thus leading to agency costs as a burden on stockholder wealth. In other words, he wrote this: payouts to shareholders reduce the resources under managers' control, thereby reducing managers' power and making it more likely they will incur the monitoring of the capital markets, which occurs when the firm must obtain new capital. This hypothesis, Jensen's hypothesis, suggests that when a company has generated excess cash flow and there are no profitable investments, management abuses that free cash flow. Now, one of my favorite investors and authors, and really he's a mentor, although I never met him, is a fellow by the name of Benjamin Graham. I'm sure many of you have heard about Benjamin Graham. It's also Warren Buffett's mentor, and they used to work together. But Benjamin Graham wrote this book, which I encourage everyone to read. I tell this to all of my students, even my kids. This is The Intelligent Investor. Now, in this book, Benjamin Graham says, paying out a dividend does not guarantee great results, but it does improve the return of the typical stock by yanking at least some cash out of the manager's hands before they can squander it or squirrel it away. Now, that's the key here, folks. Dividend policy is extremely important because it measures discipline, intense discipline of that management team to continue to pay that dividend and, most importantly, increase that dividend. Now, today, there are about 2,000 publicly traded companies, various stock exchanges, that pay dividends. That's as of about March of 2025. And out of those 2,000, 1,037 of these companies have increased them. Again, those are the companies we work for, we look for. Now, what's important is around 2/3 of those dividend growers are S&P 1500 index companies, 313 are S&P 500 companies, which suggests you can find dividend growers not only just in these big cap names, but also in the mid caps as well as some of the small cap names. So those are the companies we're definitely looking for over time.
Yeah, no, I love the Jensen study. I love it because if you go on the internet, I like to read bogglehead forums and dividend Reddits and all this stuff. A lot of trolls come into these places that hate dividends. They say all a dividend is a company taking some of its cash and giving it to you. And when that happens, the value of the company should fall by, an equal amounts of that cash. And therefore, a dividend is just a taxable event that doesn't even do anything to your stock holdings. I disagree. I think these power of dividend studies disagree. And the Jensen study, I think, makes it pretty clear, right? If there was always a great opportunity for every company to go generate some huge ROI with its capital, by all means, go invest that money. But like you said, once the cash flows become so large, you just can't do it, especially in a highly regulatory environment. I would like to see the Trump administration kind of get away from that and let these companies invest all this capital. But right now, I'm still seeing a bunch of DOJ kind of lawsuits against big tech and all these types of things. So they can't do much of that capital. I think that's why you're seeing some of these, Alphabets, Meta, some of these big tech companies start paying dividends. I think that'll continue because they don't want to squander and they're smart enough to realize that. So I love that study to show paying a dividend is okay, right? Give me that money. Let me decide what I want to do with it. Maybe I can find a great investment. Maybe I go on vacation, etc. It doesn't matter. But I would much rather than do that than just, like you said, squander it. Or I forget what the Graham quote was. He had two kind of alliteratory words there at the end, but I love that quote as well. I'm happy to see anytime I agree with Benjamin Graham and I didn't know it, that's a good day for me.
Great. Well, it's actually squirrel, by the way. So squander and squirrel. And,
there you go.
But what's interesting is in the REIT space, and my picks today are 3 REITs, and Nick's got some other non-REITs. We're going to mix it up for you, try to provide varieties, the spice of life. There's another one. Okay.
There we go.
So at any rate, we're going to mix it up. But I want to, before I get into my 3 REITs, I want to mention REITs are different. For those of you who aren't familiar with a real estate investment trust, there's a tax law that it really differentiates this particular asset class from non-REITs. And this is these companies must pay out 90% of their taxable income in the form of dividends. What that means is these dividends are much more predictable. As an analyst like Nick and I, we can predict with a fairly high degree of certainty what the dividend increase is going to be, not only this year, but maybe next year and even into the following year, because this commercial real estate has lease contracts. That's what powers the revenue, the rental revenue. So we can look at these lease contracts and determine, again, with some certainty that they're going to be able to continue to increase their dividends. So with that being said, let's jump in.
And Brad, again, maybe you gloss over this. The most important thing about those contracts is they have built-in rent escalators into those contracts. So we know a company's getting, $100 a year in rent this year, 102 next year, 104 next year. Like Brad said, with that knowledge, it's very easy to predict dividends because they're based on objective fundamentals. They're not a subjective thing. It's not like the stock market goes up every single day. That's based upon the whims and the emotions of Wall Street. But dividends, on the other hand, are based upon hard and fast numbers.
Yeah, I like to use this analogy, Starbucks. Everybody's familiar with Starbucks. By the way, I'm at Spill the Beans today, not Starbucks. But let's use the Starbucks analogy, okay? So you can either invest in Starbucks, and what you're getting is revenue generated from coffees and different products that Starbucks sells, or you can become a Starbucks landlord and say own a REIT like Realty Income is a net lease REIT, and so you have lease contracts with with Realty Income. So as a landlord or as an analyst for REITs, I can determine to a fairly high degree of certainty what the potential earnings are going to look like and the dividends for this company in the next year or two or three. However, in Starbucks, there's no way. There could be some cyclical event. We could have we could have another pandemic. Hopefully not. We could have a recession. People pull back on coffee. Whatever the case, we just don't know. There's a lot less uncertainty or more uncertainty with a company in terms of their earnings and how they generate earnings. Now, CareTrust is a very predictable healthcare REIT. That's my pick here. The CareTrust owns 406 properties. By the way, that ticker symbol is CTRE. 406 properties, 42,000 beds, pretty diverse portfolio in 34 states. Now, most of that revenue is generated from skilled nursing properties, skilled nursing homes, which also is, demand driver being the aging population, the so-called silver tsunami. And the rest of that revenue is multi-service properties as well as senior housing. Again, silver tsunami and financing of the company. They finance properties as well as own them. So that's their key driver. What I like about this company, and I'm going to put this chart up here showing the dividend growth. They've averaged roughly about 7% dividend growth over the last 10 years or so, which you can see on the screen. But what's driving that growth and outperformance in that growth is the fact that they have really attractive investment spreads. So they have a low cost of capital and they're able to generate growth of around 10%. That's what we call the yield on cost. So these investment spreads are really what generates the very reliable and predictable growth, dividend growth of this company. So I like the company a lot. Fundamentals are very strong. Their payout ratio is low, which means they have plenty of safety or margin of safety with regard to their dividend. Now, in terms of valuation, it's about a fairly valued company today. So I wouldn't go up and buy I wouldn't back up the truck per se. Right now, the multiple's trading at about 17.8 times, which is in line with kind of their normal valuation. 4.7% dividend yield. What really attracts me with looking at the future analyst consensus for this company, the estimates are about 16% in this year, 25, 11% next year. So a lot of growth. Again, we can predict that growth because of those lease contracts. The second,
and Brad, that may go out further into the future. I don't want to interrupt you. When you said silver tsunami, I know that's kind of a big trend that we use for our investing. If people aren't familiar with what that is, it just means the baby boomer population is aging now. As Brad was talking, I got on Google here. The population, the World Health Organization estimates that the population of people on planet Earth ages 60 and older in 2020 was roughly 1.4 billion. Or 1 billion, excuse me. By 2030, 1.4. By 2050, 2.1. So the Earth's population is aging rapidly, and we need a lot of infrastructures to support that, especially in the healthcare space. So that's this company not only has good short-term growth prospects, but if you believe we're going to have to house all these people someplace, and this is potentially like a multiple decades long demand story.
100%. Now, this next pick is also has a really interesting demand driver, and this is Iron Mountain. That ticker symbol is IRM. Now, some of you may remember a few weeks ago, I think it was Elon Musk went on there with his Doge platform and really went after Iron Mountain's one property, their core property, which is an Iron Mountain up in Pennsylvania. It used to be a mushroom storage facility, believe it or not, and it's one of many properties that Iron Mountain owns, and they have a very diverse portfolio. So I'm not concerned about, the government taking away some contracts. And by the way, I think what Elon Musk failed to mention, or his team at Doge failed to mention, that, there's a lot of record storage sitting there, actually pieces of paper. But the whole value proposition for Iron Mountain is not the fact that, these documents are actually physical pieces of paper. It's the fact that Iron Mountain has spent the last decade or so transforming their business model into a very high-tech business where they take these documents, put them in the cloud, scan them, put them in the cloud, and they are investing in their own data center business. That's what people need to understand. It's not the old legacy Iron Mountain. This is a new business model. They've got around 416 megawatts currently of data centers, which is 96% leased, and about 165 megawatts under construction right now. So very strong growth. They've been able to accelerate that growth. Now, I'm going to put the chart up here showing the dividend history for this particular REIT. Now, you can see here they've got a good dividend history. And I want to point out between roughly 2019 to 2022, they did not increase that dividend. But the reason for that, if you were to look at their payout ratio, they were at about 82% of their payout ratio. That's their dividend per share divided by their earnings, 82%. Today, they're 63%. So they started to increase the dividend once they dropped that payout ratio down, making it a safer play and really moving the company in line with its closest peer group, which would be industrial companies, industrial REITs. They were able now to continue to accelerate. So you can see, as I've got here in the green charts, the bars on the right, that's the dividend growth more recently. And that's pretty stellar. Analysts are forecasting around 10% growth in 26 and 27. I like the company in terms of valuation. They sold off pretty massively. They were trading at almost an all-time high of about $127 a share back in October of last year. Currently, they're trading around $84 a share. And so definitely cheaper than they were before. They've moved down into fair value. Actually, a pretty good buy right now. If you want to have access to this well-known brand and data center landlord. My last pick and is a shopping center REIT. Now, this company is unique. It's the only Dividend King in the REIT sector, which means the company has increased its dividend for not 50 years in a row, which is what a Dividend King is defined as, but this company has about a 57-year history of dividend growth. So it's managed to navigate multiple recessions, global pandemics, and different types of economies.
Take us, just stop for a second as you watch. Think about all the stuff that's happened in the world in the last 56 years, right? The technology, has gone from the computers were like the size of buses back then, I think, right? Now they're in our pockets. So the world has changed so much, and yet this company has maintained that dividend growth throughout that period of time. I think we say these things, we talk about these dividend streaks all the time. I think if you truly put it into a historical perspective, like it's a very amazing thing what they've done.
Yeah. And look, the other thing I want to point out, because this is a retail REIT, and a lot of people, when I hear retail, they run for the hills. They don't want to invest in retail. What's really different with Federal Realty is they focus on demographics. I would say demographics is the differentiator for Federal Realty. They target markets like Miami, Washington, Philadelphia, Chicago, New York, Southern California, and Phoenix. The average aggregate income within a 3-mile radius is $10.7 billion. So these are people with a disposable income around these really trophy properties. These are mixed-use developments that you can see in these major markets, which are very, very strong markets. So that's why they've been able to survive those many decades and thrive during those periods with dividend growth. Now they've also
somebody who's not familiar, mixed use is kind of the live, work, play mantra. So yes, it's that shopping center that you see, and maybe they've got an office complex. They've probably got a really nice apartment building with a pool on the roof, where you don't even have to leave, right? So that's the new trend in retail. They're these mixed use areas, and Federal does it the best, I think, because like Brad said, they only build these things in areas of the country where the income levels are very, very high. So that makes them kind of recession resistant, which is really the kind of the ethos, what we're talking about here, the SWAN type investments.
Yeah. And shares are really cheap today. So I've got a fast graph here. You can see they're trading around $93.70 a share right now with a multiple of about 18.4. And the historic valuation for this company over the last 15 to 20 years has averaged around 26 to 27 times. So certainly the company is trading at a discount. Pretty attractive yield, 4.7% dividend yield. Again, a lot of growth potential for this company going forward. So we're forecasting pretty solid returns with this one, which is somewhere in the 25% annual range over the next year or two. So those are the sum of the parts of my 3 picks. Nick, I'm anxious to hear about yours. I know these aren't REITs, and I know these are high growth machines. So What do you have for us
Yeah,
today?
we wanted to always, Brad focused on the REITs. I want to just prove to you guys what he says about the REITs applies to everything else, right? We're not just REIT guys. We know the whole market. Here's my last pun of the day. These are two stocks that I do own personally, so I'll be eating my own cooking here, per se. I'm going to talk about a food stock, PepsiCo. We talk about SWAN, sleeping well at night. People have to eat and drink. There's nothing we can do about that. Yes, the Ozempics of the world, the GLP-1 drugs have really hurt the kind of demand for these shares because people worry about less snacking, less sugary drinks, etc. I don't know what that's going to look like long term. I don't really believe it, right? I know human beings well enough to know that we can't really, stop our vices. People love sugar, they love snacking, etc. That's what Pepsi specializes in. This company owns obviously all the soda brands. They own juices. They own Gatorade. On the snack food side, they have popcorn, Quaker oatmeal, all sorts of things. This company dominates the grocery store, even if you didn't know it. It's kind of that illusion of choice thing playing out here. PepsiCo has, a dozen plus billion-dollar brands. And they've been historically, I'll put the fast graph on the screen today, a wonderful grower. Over the last 20 years, they've only done negative annual EPS growth 3 times. So 17 out of 20, we'll take that. That's really good. This company's been growing its dividend for 52 consecutive years. It doesn't get much better than that. We love that. Same argument with Federal Realty. So much has happened over the last 5 decades, and yet PepsiCo has remained consistent. And we're not talking token growth here. I typed it out here. Over the last 20 years, the average dividend growth CAGR from PepsiCo is 9.6%. Over the last decade, it's 7.7%, and the company has already announced its 2025 increase at 5%. So yes, that's slowing, but that's still well above inflation, which is so important to us. This isn't an exciting company. It's not a fast-growing company. However, after selling off massively because of these kind of GLP-1 headwinds, and maybe some of like the RFK Jr. dies in food kind of uncertainty that's popped up over the last 6 months, I think it's a pretty good deal. It's trading at below 18 times earnings. That very rarely happens, as you can see on the chart here. And that 5% growth is still well outpacing inflation. Inflation's around 2% right now. With tariffs and stuff, maybe that goes up to 3, 4, maybe even 5%. But if tariffs go up and costs rise, PepsiCo can pass that along to consumers. So we really like this company. It's boring, but oftentimes we say boring is best. It yields, something like, almost 4%. What is it? The dividend yield is 3.8%. That's well above historical average for PepsiCo. So as far as like a sleep all night company goes, I think this qualifies pretty well, and it's certainly rising up my personal buy list as the stock sells off. Moving on to a company in kind of the technology space, I want to talk about Accenture, ticker symbol ACN. This is an IT consulting business. So what they do is they teach businesses how to get better. And recently the trend's been how to implement AI. They're masters in this. They understand AI very well. They understand, human resources and all the things that nobody really wants to do. They teach people how to be more efficient at it. Any business will pay money to become a better business, and that's showing up in their results. Accenture has only posted negative annual EPS growth once in the last 20 years, and that was just negative 1% in 2010. So they were very, very close to having a perfect EPS growth record here. And you shouldn't be surprised to hear that over that last 20 years, they've raised the dividend every year because of that. When companies produce this very consistent and reliable fundamental earnings growth, they're able to sustainably increase that dividend. And it doesn't get much better than ACN. I'm looking down on my numbers here. They got that 20-year dividend growth streak. And over that 20-year period, the dividend growth CAGR is 17.1%. So that's amazing. Divide 72 by that. You're doubling your dividend just every few years here. Over the last 10 years, it has fallen to 10.7, but still wonderful, 4x inflation rate. And their most recent dividend increase was 14.7%. So we'd love to see that. We'd love to see double-digit dividend growth. The yield's 2.1%. Why does it only yield 2.1% after all of that dividend growth? The answer is a capital share price appreciation. So investors here have not only gotten a lot of dividends, they've made a lot of money, and Accenture is well off the highs. Not that long ago, kind of at the height of the AI rally before the DeepSeek news came, we were at $385 a share. Today we're at $279 a share. So it's off $100 from the highs. 22 times. I think that's pretty good for a company like this. And once again, I own it, and it's a company that I'm thinking about buying more of every single day now as the share price falls, because it's paying me every day. Well, it's making money every day. It's paying me those quarterly dividends, and every year it's growing. So I'm making money while I sleep owning Accenture.
Great. Those are two terrific picks. And I'm going to tell you, this is my last pun, by the way. I promise no more. We're going to put some icing on the cake for you guys. So next week, our next week's show is going to be our top 10 swans. Nick and I are going to collaborate. We're going to spend a lot of time on this. So we're going to be prepared next week. We're always prepared, but we're going to really be prepared next week and provide you with our top 10 swans. So please be on the lookout. And by the way, follow us. If you're not following us, please drop down below. Follow us. Drop a comment below. I'm going to give out one book every week. Give one book to somebody who comments. And I guess we just pick whoever's the best comment. And I'll give out 2 books if I have to. But please drop us a comment below. And finally, dividends are critical. These represent not only just, income, but this is the paycheck for the investor. So it's very, very, very important. And dividends signal the corporate strength of the company and the management's discipline. So us investors, all of us can sleep well at night. So I'm looking forward to next week's. We're gonna dive deep into the top 10 swans. And Nick, thank you for joining me today. It's been a terrific show.
Yeah, I don't know about terrific show, Brad. All these puns, people, we won't do that next week. That happened organically, but it was fun to do it as the show ran on. I am excited about next week. I know you guys love these lists. I love lists. I want to learn new stock ideas. I'm sure you do too. And like Brad said, the dividends are so important. We show these long-term charts, turning $100 into $16,000. How do you do that? You stay invested over the long term. Well, how do you do that? You have to have an anchor to hold on to during very volatile and tough times like today. What is that anchor? It's your passive income stream. It's those predictable, reliable, durable dividends. When you focus on that and not the share price volatility in the short term, you can become a long-term shareholder and make a lot of money. So next week, like we said, we'll talk about 10 companies that we believe will make people a lot of money over the long term. And I can't wait for that. So, Brad, thanks for this episode. And guys, thanks for watching. Like Brad said, drop a like, please subscribe. All that helps us. And have a great week. Thank you guys so much for watching this video of the Wide Moat Show. We're happy to have you here. We do please ask that you like and subscribe to our YouTube channel. And if you like the content that we're providing here, please check out the link below for Wide Moat Daily. That's our daily free newsletter where we discuss all things related to dividend stock.